Thanks to Gary recording the session just as he's just done here. So again, I'm going to turn it over to Richard to launch us into things. But thank you everyone for being here today.
And thank you, Brian, and thank you for, as always, being a host and the host with the most for the session today. And welcome everybody to the Be Your Best, our webinar series to share best practices for getting real estate deals done in New York. I'm Richard Haggerty, CEO of the Hudson Gateway Association of Realtors. We're a not-for-profit trade association representing over 13,000 real estate professionals in Manhattan, the Bronx, Westchester, Putnam, Rockland, and Orange counties. I'm also President and Chief Strategic Growth Officer for One Key MLS, the comprehensive multiple listing service for the New York region. One Key has over 46,000 subscribers and serves the region from Montauk to Manhattan to Monticello. Today, we're taking stock of the real estate market. Our panel of experts will review some of the biggest trends for 2022 and set the stage to help you gear up for the new year. As always, we're pleased to partner with TitleVest and have President Brian Tormey moderate our discussion. TitleVest is the leading real estate New York City based title insurance agency and a member of the First American family of companies, offering a full range of services for real estate property purchase and refinance transactions. TitleVest's office is in Manhattan and Westchester and engages in transactions upstate, downstate, and nationwide. TitleVest has won the New York Law Journal's Best Title Agency Award every year since 2013. Now let's meet our panel. We're pleased to have with us today Doreen Courtright. Doreen is a licensed associate broker with Douglas Elliman Real Estate. Also joining us is a frequent guest of ours, Marissa Tracy, who's the managing director of First Republic Bank. And we have another frequent guest, Jonathan Miller. Jonathan is president and CEO of Miller Samuel Inc. Doreen, Marissa, Jonathan, thank you so much for being here. And Brian, I'm going to pass it back over to you.
Wonderful. Well, thank you. And a huge shout out and thank you to you, Richard, Gary, Jeff, Kathleen, the whole team at HGAR and One Key. This is an awesome series. I love doing it every month. And I love hearing, I get routine feedback now from the market of people who are like, oh, wait, I saw your session on this. And it's just, I really think it's come to have a life of its own and really have some great impact. So thank you for bringing it together for your membership. With that, I'm going to do a little bit of housekeeping items for everyone. Everyone's attending here today. Your microphones are muted. We can't hear you. Please use the Q&A function to submit any questions you may have, and I'll be reviewing and observing those and queuing them into a verbalized question for the different panelists at the appropriate time. And feel free to use the chat function to drop any comments, shout outs, accolades, agreement, disagreement, commentary on sort of what's being talked about today. But otherwise, we'll keep all the voices muted so we can focus on our panelists. And we look forward to diving into our real session today. But before we do, Richard, we got to hear the moving market stats. What's happening out there?
So I hate to sound like a broken record, but I'm going to sound like a broken record. If you compare year-to-date numbers from 2022 to 2021, in Westchester, we're down about 15.5% single family, 8.5% for all residential transactions. Rockland County, about 16.7% for all residential transactions. Orange County, about 15.2%. As we get closer to the city, Bronx is up 6%. If we look at Queens, Queens is up 6.1%. And if we look at Suffolk, Suffolk's down about 12.5%. However, and this is the one where I sound like a broken record, if you compare the numbers to 2019, we are above 2019 numbers consistently across the board. So again, it's a case of trying to find that middle ground where you're trying to compare it to what used to be quote unquote a normal market versus the pandemic year of 2020, where we still had a strong year, and the boom year of 2021. And I think that's the challenge we're going to continue to have. The other thing that is across the board is median sales price is up from 2022 to 2021 across the board. So we still have prices increases above the board year to date.
Yeah. And it's almost like we have to, and Jonathan, I feel like you as an unofficial but official statistician probably know the right nomenclature for this, but like it's almost like we're looking at this whole larger data set of trends. And 2021 really is just an outlier that if we're trying to compare to just the outlier without a weighted average looking at 2019 and earlier years, these numbers, Richard, you're sharing these down numbers, down 16%, down 8%, down 12%. But in reality, it's really not that down when not, as you're saying, not compared to the outlier of 2021, but looked back at the predecessor 2019.
Yeah, we went through this incredible roller coaster ride. So I think it's problematic to compare against year over year, because 21 was, the way to think of it is, sort of dark days in 2020 with the, in the spring with the pandemic lockdown, and then a rocket ship in 2021. And here we are in 2022 comparing against a rocket ship when we really should be comparing to 3 years ago, same period. So it's seasonally appropriate. Mm-hmm. One thing just to throw out there in sort of complementary to Richard's stats is that new listing inventory, meaning inventory that came on in the month of August compared to the month of August pre-pandemic, so that would be August of 19, new supply coming in is down 56%. And so think about that in the context of a firm underpinning on pricing as we talk further today, that typically what happens, as looking at Richard's numbers, we see a slowdown in activity. So you immediately assume a spike in inventory. And one of the the things, the term has been used, starting to use the golden handcuffs, sort of you're connected to a rate that you refied during this pandemic boom, and you don't want to leave as a homeowner. And I think that's one of the challenges that that the market and participants in the market are going to be dealing with over the next year or so.
Yeah, we're going to come back to that concept of sort of being rate locked into your house, not rate locked into a new mortgage, but rate locked into your house.
Sure.
That's great. Well, so we're here today to sort of talk about what we can anticipate and sort of what our signals are telling us about Q4. We've got a great panel of experts. Very excited to have you all here. Marissa, I'm going to start with you. You've sort of got access to all these amazing economists and analysts sort of giving you perspective on what's happening in the economy. Are we entering a recession? And you had some really nice sort of points of perspective and wisdom on like, what is a recession and when do we know what a recession is, that kind of stuff. Can I turn the microphone over to you to give our audience a little bit of perspective on this sort of all the talk around recession?
Sure. So thank you for having me. I'm so happy to be here. But it's been a lot of news, a lot of data, and especially yesterday, right, where the Fed had their the FOMC meetings, and Jerome Powell was very vocal, had a lot of comments, and Fed raised rates 75 basis points. That was at the high end of what was expected, and basically the market listened very carefully to what he had to say, and the Fed has made it clear that their most important focus is getting inflation under control. And they are going to do that kind of whatever it takes at the expense maybe of a shorter term economic cycle to have a longer and more robust economic cycle going forward. So rates went up 75 basis points yesterday. The market is expecting that there will definitely be rate increases at the November and December meetings that will get us at year end somewhere to an increase of another 100 to 125 basis points. So that's much larger than we were talking about even a week or two when we had our pre-call.
When we were having our prep calls, that wasn't on the radar.
That wasn't on the radar yet, right? It was 75, 25, 25. Now it was 75 yesterday, and we're thinking another 50 to 75 next meeting, and 25 to 50 meeting after that, maybe even higher. So the Fed is going to be very aggressive on rates, and they're very public about that. It's really about inflation and getting inflation under control. They do not want the economy to go into a recession, so they are trying for a soft landing. But with aggressive rates like this, the market, which is why you're seeing all this volatility in the equity market, just really is worried about what could happen. We don't think rates were going to continue at these crazy increase levels for the next, 9 months, 1 year, right? They're going to do them quickly now and then wait to see if by raising these rates, they can actually get inflation under control and actually get unemployment to increase, which sounds very counterintuitive to what they're looking for. And then they're going to keep rates there for a while and sort of see what happens to the economy. Often in a recession, you don't know, they don't report that you are in a recession until you actually have data for at least a quarter or two that has actually happened. So by the time everybody says we're in a recession, it will already be, we're in it and we're coming out of it. So I don't think we want to worry about that as much as we want to think about kind of what's happening in the economy now, where rates are going to go. Rates are definitely going to go up for the next couple of months. So for buyers who are afraid to move, it's a great time to move now before rates go up again. And I think that's something that brokers can hold on to and talk to clients about.
Yeah. Yeah, because the moves, right, is just for clarity here, like the moves that just happened are sort of what was expected for the rest of this year. And now they've been clear. It's going to move even more.
Yeah.
So it creates a little bit of time pressure to go execute, go get your First Republic mortgage, go get yourself in contract, get to closing, all that kind of stuff in a near term kind of way. Yeah. Jonathan, I want to turn over to you. When we were having our prep session, this news from yesterday hadn't happened yet. And you had some commentary on like, this isn't a Lehman moment. Do you still agree, concur, any different perspectives after yesterday?
No, this isn't anything like the Lehman moment. Lehman moment was, the financial crisis was based on, sort of insane lending standards that you had to have a pulse or fog and mirror to get a mortgage. Towards
Only
the end
one
of the
or the
cycle,
other, not both.
Well, but towards the end of the cycle, it was, it might have been both. Except for First Republic, right? Because they're like, I might have a mortgage with First Republic. Like they're the best. But really, there was no financial engineering in this cycle. And that's actually one of the advantages as we go through this and look at the other side, is that lenders never lost their mind. Actually, as an industry, mortgage lending was more conservative than if you go to the 3 decades prior to the housing bubble, more conservative than a long-term sort of stabilized period. Coming out of the financial crisis, lending didn't lose its mind. So it's important to look at that going forward, that we don't have this other variable to deal with, which is going to be sort of a banking crisis. I hate people to say this time it's different, but this time it's different.
Okay, that's fair. We can use the phrase when it's appropriate. We don't want to overuse it. Very good. Well, Marissa, let's talk about New York, especially New York City, but the surrounding areas as well, are driven in part by, the amount of financial services firms that employ both the direct employees of those firms and all the ways those people spend money, including on real estate. Do you have any thoughts and perspectives on sort of as we see what's happening in this sort of Q4 economic outlook and how the year is worked out, how that's going to influence sort of like the spending habits, are we going to see big bonuses coming out of the financial services that sometimes when we have had boom years, those bonuses help drive a whole bunch of activity in Q1. Are we anticipating that, or any perspective on sort of what we're going to see from a local spending level as it relates to sort of success or non-success of some of the financial service firms?
Yeah, I think that there's interesting factors at play in financial services. So investment banking is clearly, has basically almost come to a halt. There's very little new issue going on as equity markets are going down. There's much less interest in companies looking to put debt into the marketplace because rates are going up. So on the investment banking side, I do think that bonuses are going to be down, and that will affect purchases probably at the larger end of the market.
Yeah.
But I think that the other thing that you're seeing is financial service firms are requiring people to be back at work. And you may want to talk about this later, and if so, stop me. But you know, Goldman Sachs has everybody in the office 5 days a week. Jamie Dimon was asked about that, and he was said that is the goal of where they would like JP Morgan to get to. We are First Republic, we are back in the office mandatory 2 days a week, but there's definitely a request that we should be here more. And, you know, I'm in 4 days a week. A lot of people are in 3 and 4 days a week. So what you're seeing is you're seeing a lot more people moving back into the city or to a situation, right, where their commute is reasonable, especially for people who are maybe younger and have been living with their parents for the last 2 years during COVID. If you're not remoting in, you have to be able to actually get to your office in a reasonable amount of time. And I think that that's going to drive demand in a different way than maybe you would have been seeing on the bonus side. On the private equity side, on the hedge fund side, you know, that's going to be really interesting to see what happens in Q4. There may still be very large bonuses there, depending upon, you know, where things come out and how people are investing.
Yeah. Okay. Well, wonderful. Well, Jonathan, talk to us a little bit about, you know, one of the things that you had an interesting comment on how these economic factors like inflation, right, specifically CPI, how much housing pricing impacts that, and sort of this. You had an interesting insight into sort of like this, like, you know, loop that there was creating. Yeah.
So you're asking me to be wonky right now? Is
yeah.
what you're,
Please
just
go
admit
geeky.
it.
Go
just
geeky.
admit it. All right. So, so housing accounts for about 30% of inflation calculation, CPI. And so clearly with the spike in mortgage rates have effectively more than doubled since December 31st. And that has reduced affordability, which has reduced transaction volume, right? Not pricings as much as sales activity has really been the first impact. But when the Fed does a inflation calculation on the housing portion, they actually use owner's equivalent rent, which is, they're not looking at sale prices, they're looking at rent, what that house would have rented for. And interestingly, you know, one of the characteristics of this market is that people that were, say, priced out of purchasing were pushed into the rental market, or you know, not everybody, but some people were pushed into rentals, which is already tight and is helping keep rents high. So if they're measuring rents in housing, raising mortgage rates has actually made rents, you know, solidly elevated, right? We just published today the Douglas Elliman rental report, and there are signs in Manhattan that rents are peaking, that they, for the first time in the last 7 months, median rent didn't hit a record. It's only the second highest in history. But sort of the thinking and some increase in vacancy is suggesting that we're starting to see sort of plateauing. And to Marissa's comments about the economy, the only thing I can see for rents to become more affordable is for us to have a recession. You know, barring that, I'm not sure how rents come down, because as I like to say, and this is sort of a dad joke, but not quite, is that the opposite of rising rents is not falling rents, it's stabilizing rents.
Yeah, agreed. Doreen, I want to turn to you here. Like, we're sort of talking about things from an economic outlook perspective. You're working with, you know, many of your valued customers and out there feeling and having these conversations as they're making their investment or purchase or sale decisions. What are you feeling, sort of, you know, word on the street with your clientele as it relates to sort of these big decisions, to list, to not list, to buy, to not buy, to rent?
Well, I feel like I'm very optimistic about the fall market. I feel that people that have to move on are going to list and sell, and we still feel like prices are not going down. So on the sales side, we're still seeing prices going up, there's just less transactions. But to Jonathan's point about the rentals, I am definitely feeling the pullback. And I'm having people email me about my rental listing saying, are there any concessions? So we haven't heard that word in a long time, but people are now saying, you know, I don't want to pay the fee. Is the landlord going to give me 1 month free? So usually when things turn around in Manhattan, they turn around very, very quickly. And I feel like I'm seeing a turnaround on the rentals more than I'm seeing any kind of turnaround on the sales. Most people, if they have to buy, they're going to buy. You know, they know that if they have to get a mortgage, they could get an adjustable rate. So if they're at 30-year fix for 6%, you know, they could probably get something in the 4s if they go into an adjustable rate. Most people stay in their house or their apartment for, you know, 4 to 5 years. So I'm not really feeling the economic, it's more the inflation that people are complaining about. And, you know, the things that are going on in the city, that is more the topic of conversation.
Sure. Some of the
Brian,
street.
can I ask a follow-up of Doreen?
Yeah, please.
So, yeah, Marissa and Jonathan are numbers people, Doreen, but you deal with a lot of consumers who I think probably are looking at headlines, and the headlines are all, you know, the sky's falling down. How much education do you have to do to say, don't be persuaded by the headlines, really focus on what's actually happening?
Oh, that's what I do all day, every day, 24 hours a day, you know, is try to keep it, you know, this is what's really happening, because, you know, bad news is what the news cycles, they love that. But, you know, I'm still seeing like a lot of people moving to the city, getting transferred to the city, people from out of town that want to pied a terre. Manhattan is still a place where people want to be. So that's what I tell people. And then I think Jonathan, is that your famous chart of over 30 years? Like, which way does the market go? The market it always goes up. I mean, it dips and like it plateaus and it goes up a little, goes down, but overall the trend is always up. So you kind of have to just tell people, you know, right now, if you're going to buy, you're buying in a dip in a way. So, you know, buy it and hold, and hopefully when you want to sell or trade up in 5 years, you're going to have price appreciation.
Yeah, that makes sense. You know, Doreen, you brought up an interesting comment when you were sort of saying, you know, well, instead of a 30-year fix north of 6, you can look at an ARM. Marissa, I might turn to you here to talk a little bit about, you had some interesting commentary around as the rates really move up, and on the heels of yesterday, we're going to see that happen. You had some good advice around relationship pricing and different product types, as Doreen was referencing. Can you give some perspective to our, you know, agent brokerage community around what are the tools that they can avail of themselves, what are like for their clients?
Sure, absolutely. So I think that what sort of buyers or people in the market are seeing are these crazy headlines, right? Mortgage rates are at 6%. Barron's just come out and said 6.25%, highest mortgage rates since 2006. But actually, those are not mortgages those are not the rates that people are paying if they're at a relationship bank. So if you have a client who is interested and able to build a relationship with the bank, they can come in with a mortgage. But if they come in and say, yes, I'm going to open a banking account with you and I'm going to deposit X amount of money, then rates are very different. So at First Republic, for me, if a client comes to me or a prospect, they don't even have to be a client yet, and they're willing to begin a relationship, put 15% of the purchase price in a checking account. The 10-1 ARM as of today, I priced it an hour before the call, is at 410, and the 30-year fixed is at 435. Now rates are moving, rates went up yesterday, you know, rates are fluid at the moment, but that's almost 2% lower than you're hearing in the headlines. So I think it's important as a broker for you to say, do you have a banker that you're working with? Have you called them and said, I'm hearing what's in the headlines, but what really are mortgage rates looking like? And if they don't have a bank that does relationship pricing, that you help them find that or recommend that, because it's a huge difference in a number. So I think that that's super important. And we're seeing clients, you know, finding opportunity. I think the other thing that everybody forgets that we talked to Jeff about is, you know, in 2000, rates were at 8%. And all of these refinances that you've heard about over the last 5-6 years came as people who had higher mortgage rates dropped, they went out and they refinanced. So the answer is, if you're buying now and someone says, well, rates are at 6, maybe you can get it at 4, but that's still so much higher. The answer is, yeah, but you can buy now. And if rates come down in 2 years, you can refinance. So you have that flexibility. You're not locked in forever.
Yeah. Yeah, there was this great line, Doreen, it might have been yours. I don't remember whose it was sort of like, you can always refinance later, but you can't change your purchase price later. Marissa or Jonathan, whose was it? It was a great line.
I wish I could take credit, but it wasn't me.
Yeah,
Okay.
I can take credit, but I didn't say it.
Okay, then Marissa, it must have been you, because I remember it in one of our prep sessions. So it must have been you. Like, you can't change your purchase price in 2 years, but you can change your interest rate. Yeah.
You can change your
That's-
interest rate. Exactly. And we don't think, rates aren't going to be here for the next decade, but they're going to be here for a while, and they're going to go up from here. So if you need, as Doreen said, if you need to buy in the next year, now's the time. Buy.
Yeah.
I can just to add to Marissa, I can tell you that was that was what we ended up doing at the time. We just bought a house, and the going rate was like 5.25, and we financed it just under 4.1. I mean, it was sort of mind blowing, but it.
So what you're
makes a
saying
difference.
is, people shouldn't just go to bankrate.com try to find their mortgage. They need to have a relationship like with you, Marissa, at a relationship bank like First Republic.
Yep.
I think that that's especially important in this kind of market, right?
Yeah.
When
Things are moving,
money was
it's climbing
cheap
up.
and things were moving like crazy in in early 2021, and you were just moving, it was different. But now I think that relationship banking really makes a difference on a client's pricing.
Yeah, no, very much so. One of the comments that sort of comes out of this, because we're sort of saying like, you can do your mortgage now and refinance later. It's actually a personal story, which I shared with some of the panelists here. And I'm going to acknowledge, Richard told me not to acknowledge that it's my own personal story, but I'll acknowledge that it was my own personal story. And I missed something on one of my own transactions, my own home, until I was right on the eve of closing. But I, went and was doing a mortgage, and I found out only on the eve of closing, as I was reviewing the documents, there was a mortgage tax non-assignment clause with the lender that I was going with at the time, which meant that if I wanted to refinance later, I would have to repay all my mortgage tax. They wouldn't assign the loan to a new lender and allow the new lender to do a CEMA, and thus save on using Section 255 of the New York State tax code to allow me to do a CEMA, Consolidation Extension Modification Agreement, which most real estate agents aren't necessarily focused on that part of the transaction, but it was a purchase money mortgage, right? And it was something that even I, an industry participant, I did end up catching it in the fine print, but only the night before my closing. And like, that's not the time to catch it. And so it's an interesting comment and word to the wise, all of you agents and market participants out there, help your customer think about that aspect. If part of what they're planning to do is buy now at today's rates and refinance later, make sure that refinance option for transactions here in New York, especially New York City, the mortgage tax is very high. You want to have your lender, whomever you're doing with now, allow you to assign it to a new lender or the same lender to save on those mortgage tax savings later. Because I will say, for me, I did the calculus, and it took me, I needed more than an interest, one whole point, to more than justify doing a refinance. And it really sort of just was a pain to be looking at writing a big fat check again for mortgage tax for no good reason.
And Brian, to that point also, you want to make sure that there's no prepayment penalty on the mortgage. Yeah. So they're rare to see now, but I think as rates get higher and money gets more expensive, you'll start to see a prepayment penalty could be slipped in for if you refinance in a year or 2 years. So you want to make sure that's not there either, so that you can take advantage, as the market moves.
Yeah, no, very much so. And if only I knew you then, Marissa. Unfortunately, I didn't. You weren't in my life yet. Okay, so let's chat through. I think we've covered the interest rates. To our panelists, any other commentary on the interest rates? We sort of feel like did a good job touching on the various moves there.
Jeff had asked me to do a quick analysis. I don't know if you want about sort
Oh,
of what a monthly payment actually looks like when you have
yeah.
clients
Do
who
you
are
have
thinking
that?
about renting or buying. So super quick, but we were talking about how expensive rents are, sorry,
Mhm.
and but clients not wanting to buy because of interest rates. So if you purchased a $1 million home, so if you did a $750,000 mortgage on $1 million purchase for a 30-year fixed at 435, your monthly payment would be $3,734. Given where rents are that we're seeing, that could be a really compelling number to give a client. And I can
Yeah.
quote other numbers if you want, and bigger numbers, but just to sort of give you a handle on that. Because I think as clients are thinking about renting versus buying, they're not necessarily looking at what their monthly amortization payment would be.
Yeah. And then there's the other factors, which I know you provide for your clients in a more in-depth analysis, which includes the tax
Right.
deductibility of that and the impact of that. And out of that, just shy of 3,500, the amount going towards principal, right? Which is paying down your debt in an asset you own that presumably, per Jonathan's 30-year plus chart, is appreciating over time.
Exactly. Now, there are other things, right, that go into this, like real estate taxes and insurance,
Mhm.
which are, insurance is higher when you own. There aren't real estate taxes when you're renting. So we can factor all of that in. But the numbers are pretty compelling as
Yeah.
to buying versus renting, especially in this current market where rents are so high.
Yeah.
And
Doreen, is
one
that
thing,
something?
Brian, that I think we're going to really start to see is because we had, rates at such a low level for so long, there was pain caused by the cap of the self deductions. But I think that pain is really going to start to increase pretty significantly with the rates increasing.
Oh, I think you're totally right. I hadn't even never thought about that, but I think you're right. So that all of a sudden you're paying this, but the deductibility is still capped out. But now there's more dollars going towards it on the average home. More homes are gonna cross over that cap threshold at higher rates. Yeah, that's a very good point, Richard. Doreen, I was gonna turn and ask you, is that kind of analysis and helping? You've got a customer who comes to you and says, I'm they're considering selling, and then they're either going to go rent or buy, and they're trying to make that buy or rent decision, or they're a buy side, and they're coming to you to say, hey, I'm looking at buying, but I could rent, whatever. Is that a part of your practice to sort of talk with them about the buy versus rent finance piece, and sort of just maybe not doing all the math that Marissa and a bank is doing, but sort of talking through the dynamics and the tax deductibilities? Does that fall into sort of some of your practice?
Absolutely. Absolutely. And what we like to say is you could either pay your mortgage, or if you're renting, you're paying somebody else's mortgage.
That's another good takeaway. I think we're getting a lot of one-liners out of today. I
Yeah.
love that. You're
Yeah.
either paying your
So,
mortgage or someone else's.
yeah. So, even if you have to pay another $1,000 to get a 1-bedroom, in your monthly costs, I do go over the numbers. And then I also talk to people about, especially if they're buying condos, you could live there for 5 years. And then, if you outgrow the apartment, you could keep it, move on to a bigger apartment, and then keep it as an investment property. If the numbers work out, and by then you could rent it out and it'll cover your payments. So yeah,
Yeah.
we definitely, I never knew that real estate was so math orientated.
Yeah. Who knew? No. Well, so Doreen, I actually want to stay with you. I think one of the important topics for us to turn and talk a little bit today is, as we look at Q4, and sort of what's happening as it relates to the real estate world, this whole, the trends inside the back to work space and the trends inside the rental market, like these are things that are going to impact this. What are you seeing in sort of some of the back to work things as it relates to, the rental market and the purchase market? Like, what are you seeing with the back to work moves?
Well, especially for the younger people, like the people who graduated college a couple of years ago and they moved back to their parents' house, they're all moving back to the city. So I feel like the lower end of the rental market is still very, very competitive, because people are back to the city. I mean, I know I've been on the subway. I'm sure everybody's been watching TV. The ridership on the subways is at record levels like the last couple of days. You get on the subway, it's like there's like nothing ever happened, you know? And but I feel like the people that I deal with in sales, most of them did not leave. Like they didn't, you know, maybe they have a house in the Hamptons, or they did go to up to Hudson, or they, you know, they moved to Wisconsin to be with their parents for a couple of months. They still kept their properties here. So I'm not really seeing a lot of people coming back to the city to buy because they have to go back to work. It's more, I would say it's more on the rental end.
Okay. So not a lot of out sales during the pandemic because someone moved somewhere else, but a lot of giving up their lease. And now they're coming back and either deciding to buy or rent, but coming back to the market as a non-owner.
Yeah.
Yeah. And yes, I can attest from riding the subway a fair bit yesterday. It was busy. All
It's
uptown,
packed.
downtown. It was packed.
Yeah.
Very much so. I was on like 4 different lines going all over the city, and it was packed.
Even Midtown is, you know, packed.
Yeah.
You know,
And
you're walking down Madison Avenue. It used to be like a ghost town last summer, and now it's just like totally normal.
Yeah.
I think Marissa made this point earlier. I was down in Midtown earlier this week, last week, and it had been dead. And I walked by to the University Club for a work function, and it was packed. There were people outside. I passed BlackRock. You could tell the workers were outside. It was a great day. And I got to the University Club, and that was full steam with a lot of work events. So there's a big change happening right now.
Yeah. You know, I'm going to go off on a little tangent. I've been talking with a couple business owners who are seeing that as they're trying to bring people back, those people are relocating so they're within an easy commute distance of the office, whereas some of them were living for a while not in an easy commute distance from the office. But they're not necessarily in the office 5 days a week. Some of those days they're still working from home, but they are getting out and about still. They're still meeting up with their coworkers for after work drinks, even though they all worked in their apartments for the day, right? Like there's still after work drinks, even though none of them were in the workplace. And there's this sort of new social phenomenon that seems to be showing up, which is like planned work social time and outings that even though you weren't, it's almost because you didn't spend the day together in the office, you get together outside work.
Yeah, it's an interesting period we're going through right now because, you know, the sidewalks are full, the rental market's, you know, at records. You know, the sales market was, you know, really ramping up until rates spiked. And yet office towers are 60% unused. And that's, it's ratcheting up, but it's still, there's a big disconnect. And I think the disconnect is what I was saying after 24 hours into the lockdown was that the sort of the tether between work and home got infinitely longer. And this has been a long sustained period of time where people developed habits and are used to a certain way of interacting with work. So the financial sector has been really sort of hell-bent on getting everybody back 5 days a week. Initially, Goldman Sachs, Morgan Stanley, and JP Morgan tried in the beginning of in the summer of 21, really aggressive, and they got pushback. And now they're trying again. I think Jamie Dimon actually said that, you know, we'll settle for 3 and then we're going to press to get it to 5, you know, instead of saying you're in the wrong industry unless you're here 5 days a week, because they're worried about, you know, losing, you know, the quit rate and all that. But I think it's important to note that people are in the city, you know, because, you know, it doesn't sort of necessarily connect. There's just as many remote workers, you know, in the city, working in the city, as thinking of it in the suburbs, not a suburban city sort of relationship. But I don't think we're going to 5 days a week. I mean, there's a partnership for the Greater New York came out with, and they're a trade group sort of rah-rahing the city. But their stats showed that only 8% of office workers were working 5 days a week as of about a month ago. And I know, you know, there's been an uptick in people coming in, but I think too much time has passed. And I think even if we see more than we did before. I don't think we're going to go back to sort of pre-pandemic norms, even in a recession, because I've had a lot of people say, hey, you know, you want FaceTime with your boss in a recession so you don't lose your job. I still don't think you're going to have 5 days a week as anywhere near a norm, you know, going forward. And that has a lot of implications, or maybe not, for how we think about housing.
I just want to kind of now put my employer hat on. I mean, we've been at 4 days a week for a while, and I don't see that changing. But there are some things that have changed in the new environment, and I think that we recognize for our employees, there've got to be quality of life issues. So if somebody calls me up and says, my son is sick and my spouse is on the West Coast on a work trip, we're going to be we already are, much more flexible in saying, yep, work from home for the balance of the week.
Right.
Because we recognize that we have to be flexible, and it benefits everybody. We can't
Such
say,
a
well,
great
that's not
point.
my problem. You know, find a way of getting yourself in the office. So I do think that mentality is here to stay, and it probably is a very good thing, quite frankly.
It is for quality of life. And I also think that you have industries, you know, some industries more than other are collaborative. And so you need the in-house, you know, attendance more than maybe some other industry. I think we should all think of this as a learning curve, and we have like 3 to 5 years in front of us. I don't think anything is being resolved right now. I think this is, you know, an experiment, sort of trial by fire still.
Yeah, no, I think you're right, Jonathan. It's going to take a while to shake out, and whether or not we have a COVID flare this flu season, right, this winter season as we go into it, I think we'll have a very big, you know, that's going to have a big impact one way or the other, in either helping people feel comfortable or not.
Right.
That's great. Well, Marissa, I want to turn to you. We've actually in some of the past things, you know, we've talked about sort of this commutable distance piece, and you were sharing a little bit earlier in today's conversation about some of these firms like Goldman and JPMC and stuff who are starting to say, you know, at least 3, 4, maybe 5 days a week in the office. Is that changing the equation, you think, on what constitutes a commutable distance?
I think it is a lot, and we're seeing it. So the beginning of the pandemic, we saw a lot of clients going out and buying, you know, in the country, whether that was the Hamptons, you know, outer Westchester, Northern Connecticut, because all they wanted was space. And it didn't matter if you were 3 hours from the office because no one was going in. Now that, you know, now that people are going to have to be back at work, 1 day in the office, maybe even 2, you can commute 2.5 hours each way. Once you have to be in the office 3 days or more, that you can't spend 4 or 5 hours a day commuting. So that changes the dynamics, and I think forces people to come closer to the city or closer to where they're working. And even if they're not moving into the city, you know, that increases that demand for Long Island, Westchester in that sort of hour commutable distance. What's also happened though is if it is only 3 days and it's not going to be 5, maybe you know, an hour and 15 commute or an hour and a half commute that you would have said, I would never do that 5 days a week, you're now willing to do 3. But we're definitely seeing people coming closer and buying more closer to the city, and that I think that the people who bought out in those vacation locations are rethinking, you know, whether they're going to be able to hold 2 large apartments now that they're going to come back often with kids or family members, and it's not oh, I can just take a 1 bedroom and be there 2 days a week.
Yeah, yeah, very much so.
I'm actually one of those people. I moved a half an hour further in Connecticut. I went from an hour commute to an hour and a half commute because I'm only commuting 2 days, maybe 3 days a week, more 2 than 3. And it's just no big deal. If it was 5 days, no way, even 4.
Yeah.
The other thing I think is interesting to sort of piggyback on what you were talking about before in New York is how crowded the restaurants are. So while the offices may not be incredibly crowded, the restaurants are packed. They're packed down in the Village. They're packed, you know, in Alphabet City with younger people. They're packed. I was at Cipriani with a client the other night, you couldn't get a table. I mean, I've never seen so many people. It was, forget pre-pandemic, it was like, you know, there was a party. So I think people are interested and excited to get back out and see people and pretend that it's normal or we're back to normal. And I think that's changing the way the city feels. It's really a big change since Labor Day.
Yeah. Well, I want to turn, we've got 15 minutes left. I want to turn a little bit to sort of like a more forward-looking outlook, like what we see coming down the line. And Doreen, I want to come back to you. You had some very good, interesting commentary on sort of like the amount of inventory out there and the direction you're seeing that go, of how much inventory and stock is out there as there are inbound pressures on that inventory.
Well, we had our meeting yesterday in the office, and actually a lot of people showed up because there was pizza. But we talked about inventory, and right now there is between 4 and 5 months supply. And in a normal market, it's more like 8 months. So I think in all of the city, there's 7,000 apartments for sale. And Jonathan probably knows these numbers better than me.
6,800. So
Okay, well, I was
7,000 is
close.
pretty darn close.
We'll give you the roundup there, Doreen.
But like
Okay, Jonathan, this is where you have to take your wonky hat slightly off and let her round the numbers.
All right. All
I
right.
think in 2008, after the last big recession and housing crisis, I think we went up to about 12,000 units. Is that correct, Jonathan?
Yeah, a little over 11,000. Sorry, Brian.
Okay.
I don't know how to round.
So right now we're at 6,800. That's very low inventory. So people at the meeting were complaining. They have 2-bedroom buyers that want to buy, you know, downtown, and they want to spend $2 million, and there's just nothing to show them. A good indication for me is my email. I get emails all day long of brokers in search of. I'm in search of a townhouse. I'm in search of a 3-bedroom on the Upper East Side. I'm in search of a downtown 2-bedroom with outdoor space. Everybody's trying to go find the inventory because it's not listed. So everybody's trying to see who has what's coming on the market. You know, are you working on a listing that it's going to be on in 2 weeks? Maybe I could get my buyer in there before you put it on the market. So there's a lot of that going on. So because the inventory is low, it's going to put pressure on pricing. You're not going to see prices going down when inventory is low. It only happens when inventory spikes and buyers have their, you know, they could, you know, choose from 10 apartments. That's when prices start to go down. So I feel like prices are going to stay stable. I don't feel like they're going to go down, and I feel like they're probably still going to tick up. I was in one bidding war this week with a property on the Upper East Side that was, the minute you walked in, you go, this is going to sell like today. It was in pristine, renovated condition, and everything else that we were seeing in that exact price range needed a gut renovation. And my buyer made an offer almost at the ask, and then increased his offer when he got outbid by someone else by $100,000. And that was under $1 million.
10%.
So, and that's still going on with with properties that look good, that don't need work, that are priced correctly in neighborhoods that people want to be.
Yeah.
So,
Yeah, actually, in the current bidding war situation in Manhattan, the average bidding war results in an overpayment, meaning above list, of about 13% on average. So she's seeing exactly, you know, what we're seeing in the data.
Yeah, I agree. Now, Jonathan, I'll mention we've got some good questions actually from my dear friend Lee in our Q&A. They're going to a topic from a second ago. We're going to come back to those in a second for you, Lee. But I want to stick with this for a second. Jonathan, you made some interesting comments on there being, you know, like a firm bottom in this market. Can you explain that commentary to our audience?
Yeah, I think this was in the narrative where I said I hate people that say this time it's different. So just the precursor to that. But the way to think of in at least, you know, I've been around for almost 40 years, and any cycle I've been in, typically you see inventory rise immediately when sales activity falls. You don't see prices correct immediately. That takes a year or so. It takes a little bit of time, but inventory, because prices are sticky on the downside. In other words, sellers that don't have to sell and don't get their price don't sell, right? And that's a typical scenario. However, what happened in this cycle is that inventory was obliterated. It was, and I said this in an earlier webinar today. I look at where I moved from in Darien. This sort of summarizes what I'm seeing in most of the markets, and it's important for the brokerage community to understand this. So in my town, there were 200 listings at any given time in the 3 years prior to the lockdown, plus or minus seasonal changes, but around 200. And then after the pandemic hit, and a year into the pandemic and rates had dropped, there were 50. So everybody's saying, wow, inventory went from 200 to 50. And then in the beginning of 2022, there were 12. And so now when you get sort of stories, inventory's quadrupled. Okay, so it's 50, right? It's
From
still
12 to
75, right? It's still 75% in this my former hometown. It's still 75% below what would be considered reasonable. And I'm seeing this around in many markets in the US. So we're seeing these numbers. And so what happens when you have less competition for inventory, like Doreen is talking about, you have this firm underpinning where there just is not enough supply to allow some sort of significant correction. And on top of it, lending was conservative, relatively speaking. So people were qualified. And so I think the scenario that we're looking at is just lower volume, and maybe depends on the market, but stabilizing prices, some markets seeing maybe single-digit declines. But considering that prices for the last couple of years have been going up 20% a year, we have the highest amount of equity in homes in the US in history. So that means no foreclosure crisis, because people can sell out of problems. There's some sort of silver lining in this in terms of longevity of the condition we're coming out of was not sustainable.
Right. Well, this harkens back in some way to Richard had an interesting stat in his sort of market stats moment at the beginning. And Richard, I might get this slightly wrong, but I think you said that comparing inventory from present to same period 2019 was today's inventory is down 56%. I think you said something like that. From
Jonathan said that.
Oh, that was Jonathan's. Okay.
Now Jonathan gets that from our numbers. So.
Absolutely. But I sweated the details.
Yeah, that's what you're talking about. And I think that's one of the great values of this kind of program, because news, like, look, the news outlets are seeking those sort of exhilarating headlines, like inventory up, 400 times, right? From 12 to 48, right?
I'm sorry to interrupt on the media point. I think, our industry does, and I'm guilty of it too, and I'm in the media a lot, but just like the interpretation can be simplistic. And I think the brokerage community, the stats and the stuff that's being said here is very compelling in terms of, narrating or framing the story in a very accurate way. And I think, as Doreen said, that's all she does, right? And so I think it behooves everybody to be, very, in this period, maybe more analytic than you have been in the past or during the boom.
Yeah, no, very much so. Well, very quickly, Lee, I'm going to answer your questions in the Q&A section. Lee was hearkening back to, in this case, I've admitted it was my personal transaction. And yes, the fine print of my purchase money mortgage didn't authorize the lender to not assign their mortgage. I was giving permission that they agree, that we were in mutual agreement that they didn't have to assign their mortgage to an outside lender. It's a protectionist type clause that some lenders will put in to help keep the loan with them. They want the loan at that rate and they want to keep it on their books. And so they put in this sort of protectionist clause, and I didn't catch it earlier in the process to be able to say, I don't want that, or let me push back against that. So it was functionally a clause that said, I've agreed at the time I signed the mortgage that they don't have to assign the mortgage, which meant that I couldn't do a SEMA, to just clarify and confirm. And it meant that if I wanted to refinance, I needed to rewrite the check for my mortgage tax, which was a 5-figure number, not a fun check to write again, right? So that's just a quick thing there. I want to come back and just to sort of wrap up, Doreen, you had some great comments. We started with sort of like a definition of a recession, that kind of stuff. And you had this great comment that I think is just good wisdom, right? Even if it is a recession, and I'm going to let you share your advice here.
So I was at an event and they had an economist talk, and he had a slide on the screen that the last 5 recessions, only 2 of them, real estate prices went down. So everybody's talking about a recession, the R word, oh my God, a recession. That is not necessarily a bad thing for real estate. You're still going to probably see price appreciation. And out of the last 5 recessions, one of them was a housing crisis. So you can't even really count that.
No, very well said. Well, with that, we're pretty much at time. Any closing comments, Richard and anyone else? I mean, my dog has a few closing words, but
well said. Your dog's well spoken.
He's well spoken. We have a very articulate Belgian in our house. But I'll say again, thank you everyone for being here. I think as we're heading into this Q4, this kind of sage advice, and as Jonathan, you said, really laying out the context and taking it as the time to understand the nuances of the moving factors allows the membership and the audience here to go have those conversations, much as Doreen does, with their customers, and really help explain the different moving parts in a way that no one news article or one blog post or one podcast could possibly try to encapsulate this much perspective and wisdom from many different angles. So, Jonathan, Doreen, Marissa, thank you so much for being here. Richard and the whole HGIR team, thank you again for hosting another fabulous Be Your Best series, and very excited to keep doing these. We've got some more exciting ones. I think we've got an in-person one coming up soon. Speaking of back to the office.
Yeah.
Thank you for having me.
Thank you. This was
Thank you so much,
appreciate it.
Richard and Brian. It was lovely to
Brian,
be here.
thank you as always.
Absolutely. Thank you all. Have a great day.
Bye.
Bye.